Hello and welcome. I'm Steve Bennett and I'm the CEO of the Direct Business here at Charter Hall. Today I'll be talking with a colleague of mine, Mark Ferguson, who heads up the Maxim property securities area at Charter Hall. Mark will be providing an update on the A-REIT market as well as an outlook for the year ahead. Welcome and thanks for joining us, Mark.
Thank you, Steve.
Let's just jump into it. Some of the audience will be more familiar than others, but what do you think are some of the key benefits of investing into A-REITs, Australian Real Estate Investment Trusts?
Well, the key benefits really are the security of income. Australian REITs offer a 4% distribution yield, as well as compound annual growth over the next 3 years of 3%. And it gives investors access to the highest quality securitized property in Australia.
And we love that at Charter Hall. As an institutional manager, being able to access the highest quality real estate, whether through listed vehicles or unlisted, is what we're all about. Okay, very topical at the moment. How do rising interest rates, and we've had 13 increases now to 4.35%, how have they impacted the sector?
Yeah, well, they've impacted the sector, Steve, in two different ways. In terms of the short interest rates, that's meant higher debt costs, and that's impacted distributions and earnings in a negative way. Yep. And then in the long term, the long-term interest rates, 10-year bonds have impacted property valuations. So in other words, valuers' discount rates have increased, property capitalisation rates have increased, and that puts further pressure that has put further pressure on A-REIT pricing.
Okay, so conversely, a lot of market pundits are calling top of the interest rate cycle. I think the big four banks have now all forecast a cut in Q3, Q4 this year. Do you think that sounds like that'll be good for A-REITs in the medium term?
Absolutely.
Okay.
Yeah, and if you like, we'll be starting the new property cycle.
Okay, excellent. Once we get through reporting period, I guess.
That's right.
Okay. Direct property values. We've seen a lot of the groups announce valuation write-downs at 31 December. It seems pretty broad-based, different levels of write-downs depending on the sector. Why would you consider A-REITs if this is happening at the moment?
Well, with Australian REITs, what we can see is they're trading at 10% discount to net tangible asset backing, and in some cases even more, up to 20% or 25%, Steve. And so we would say that's in the price. And the listed market always prices forward, and the direct market is based on one point in time. So what we'd say is that the listed market has incorporated all that negative news in the price up to date.
Okay, that makes sense. So it's built in already, so then
Correct.
As interest rates come off, you'd expect it to continue on the positive. Okay. Within the A-REIT market, in your opinion, which areas do you think look the most attractive in 2024? And maybe just a brief point on why.
Yeah, sure. We particularly like some of the high-quality office portfolios in the market.
Seems counterintuitive.
Yeah, it does, but they're trading at something like 20% discounts to their net tangible asset backing, which we think is excessive. Some of the lower quality portfolios, perhaps that's fine in pricing. The other areas that we like is some of the fund managers, and that is particularly A-REITs that have fund management businesses in them, and the market's attributing zero value. So we can see as the interest rate cycle turns that multiples will increase for these fund managers, and that's a major positive.
And they tend to be, I guess, the fund managers, whether in property or other areas, more leveraged to the cycle as well. So if we have hit peak rates, they should potentially come out of it stronger than, say, a passive REIT.
Correct, absolutely.
Okay, we talked about office briefly. Interesting that you think a lot of it's already priced into those office REITs. There still is negativity surrounding the office market. Do you think it is fully reflected into the A-REIT pricing?
By and large, yes, Steve. What we can see is the whole work from home thematic has prolonged the cyclical downturn in the office market. And what we can see is corporates are working out what their space requirements are. But again, the large corporates want the high quality office portfolios in the core locations with the best amenity to get their staff back into work. Yeah,
and look, we're across the 1,600 assets Charter Hall manages. That is a thematic that we've seen across the various portfolios as well.
Yeah.
Okay, ESG, it's topical in all things these days, but particularly investing. How are REITs managing this? And I guess as a portfolio manager, how do you build it into your stock selection process?
Yep, absolutely. Well, we look at the three aspects: environmental, social, and governance. And those three components roll up into what we call a quality score. So we assess every REIT on that basis, and it does vary from REIT to REIT in terms of the quality. And with that quality score, we then match that up to what we have in our valuation. So when we combine what our valuation is and the discount or premium, combine that with our quality score, which has ESG embedded within it, then we put our portfolios together.
The logic there is that the portfolios and the managers that are reflecting this into, I guess, how they construct their property portfolio should perform better over the longer term as your tenants and investors are demanding it.
Yeah, correct, Steve, yes.
Very topical, this one, but we have seen two proposed scrip mergers in the A-REIT market this year. What do you think, we won't comment on those per se, but what do you think the outlook is for more of that M&A corporate activity in the A-REIT space?
Well, Steve, every cycle we see M&A, and it's always at the smaller mid-cap end of the cycle of the REITs. And we think that this will accelerate this year. And the point being is when we look at the cost of capital differential that opens up between the well-managed REITs and the poorer managed REITs, that is when you get M&A activity. And we see M&A activity intra-sector as well as potentially the arbitrage situation where there are take-privates. In other words, the listed market is trading a lot cheaper than what these portfolios would be trading at in the direct property market.
So in some cases, and Chartwell's done this previously, you take a listed group private, typically to wholesale clients, because, as you said, you can pick up the assets at a better price point than you could in the physical markets.
Absolutely.
So which do you think are the most underappreciated areas of the A-REIT market?
Well, we quite like the affordable residential rental market. And from what we can see is the sell side does not have good research coverage on it. And we also specialise in some of the more alternate property subsectors. And again, the research is fairly sparse. And I'm talking about research into data centres, self-storage, childcare, and the like. And often these areas, they have pretty good growth profiles ahead, and they're exposed to what we call societal megatrends, where they're going to be generating good property returns for investors.
I guess that is the benefit, isn't it? By having an in-house team here, we can divert the time, the expertise, and try and unpick some bargains that perhaps aren't being focused on by the bigger equities houses.
Correct, yeah.
And finally, what do you think the outlook is? It's a tough one. Forecasts are always tricky, but what do you think the outlook is over 2024?
Steve, I think if you look at the distribution, we'd be looking at 4% to 4.5%, so we think that's not bad. And then growing what we can see in a similar range for earnings as well, in that 4 to 4.5% over 24-25. We're very positive on the market.
Okay, fantastic. Well, look, thank you, Mark. It's great to have you here today. Hopefully you've learned a few things about the A-REIT market more generally, and more specifically, what sort of trends Mark and the team are expecting to occur throughout 2024. Thank you very much, and should you need any other information, there'll be some details up on the screen, so please do reach out and contact the team. Thanks.